All right, good afternoon, everybody. How are we doing today? All right, Craig, thank you. So everything's good to go, audio and video. Hey, Mike, how are things in Dallas, Texas? Hey, Lau, everybody. Great to have you here. Hope everybody's had a great trading week and a great trading morning so far here. And we took a little bit of a break last week from webinars. We were all out in Las Vegas, Nevada for the big money show. Daryl and I were out there and got to be out there with Chip and Dan and the Nadex guys. We had a really good time together. So we're back at it here with you today. So let's get our recording going here so we can move right along. We've got a lot to cover today. All right, so welcome everybody to the Nadex Application and Strategy webinar series. My name is John Skelton with apexinvesting.com, and this webinar today is brought to you by and hosted by Nadex, so we appreciate them having us. And today we're going to kind of go back to the basics on a particular strategy that you may have heard me teach before, and you may have heard a little bit about, but it's called the Ultimate Hedge strategy. And really want to go through and show you some unique ways to utilize Nadex spreads. And this is going to be kind of a basic foundation of the Ultimate Hedge strategy. And we're going to actually do some building on this over the coming months here and get a little deeper, show you some various ways to trade Nadex spreads directionally, trade them as hedges, premium collection, some really great things with Nadex spreads. So let's get our disclosures knocked out here so we can move forward. As always, trading futures, options, or any financial instrument involves risk, may not be suitable for every investor. Information here in this webinar is for informational and educational purposes only, not an offer or solicitation of an offer to buy or sell any financial instrument offered by Nadex. Past performance not indicative of future results. Also, on today's webinar or any webinar you hear me do, if I show you a trade entry for a Nadex binary or spread, that is in no way advice. It's no way a trade recommendation. It is simply me trying to show you the strategy or explain how we might do the strategy, show you how to enter and exit orders on the Nadex platform and use the ticket extensions. It's in no way advice, okay? If you're brand new to Nadex, okay, and again, anything you do see me do today or on any webinar will be on a demo account. And if you hop on over to nadex.com, you get some great information on Nadex. Basically, they offer two different products, binaries and spreads. You can go here through these tabs and get some general information on them. Right over here, the Learning Center. This is a great resource. You can go right here to webinars. This will show you all upcoming webinars in the future. So you know what subjects are coming up. You can get signed up and registered for those webinars and get reminder emails about them. You know, you've got different videos, trade examples, ebooks, some great information here. But I want to bring your attention right here to Webinar Archive. Okay, if you've missed some of our past webinars, go here to the archive and scroll down here, filter by presenter, find us right here, Apex Investing Institute. And this is where the recordings of our past webinars have been. And yes, today's webinar is being recorded, and this is where the recording will be later on. Okay, so you can always go back and catch up. And today we're going to be talking about the Ultimate Hedge with Nadex spreads. I'm going to do a very brief kind of quick jet tour review of the basics of spreads, and then we're going to go into it. But, you know, if you're not really familiar with spreads, you can go back through here and you can find all kind of great information, all right, all the way back to the very basics, okay, of the spreads 101 right here, back to the basics with spreads. Hey, I don't know what a spread is. What is a spread? How does it work? This webinar kind of holds you by the hand and walks you through what is a spread, how does it work, some do's and don'ts. And then we've got a lot of other webinars that build on that, about choosing the right spread, common mistakes with spreads, common misconceptions with spreads, some strategies, a lot of things to build on there. So if you've missed anything, go ahead and check that out, all right? Nadex does a great job at providing its members with a ton of free education and information, ton of different ideas of ways that you can trade their products and incorporate them into your current trading as well. Another great thing they offer right here under the trading platforms, you know, you can go directly to the online Nadex platform. They've got a great mobile app, you know, for your Android phone. And then right here, demo trading platform. All right, you go to demo trading platform. Nadex will give you a free $25,000 demo account All you got to do is fill out some quick information and hit submit. All right, in just a few moments, you will get an email with a temporary password, and you can log right into a Nadex demo account. All right, and it's a great place to get familiar with Nadex, get familiar with the different products they offer on binaries and spreads. Great place to practice entering and exiting orders, and to practice any new strategies or systems you may be learning. Much better to practice those things in a demo account than with your live money, right? It's a very expensive way to learn and test is with your live money. So test things out in your demo account. Even the strategy I'm teaching you today with the ultimate hedge strategy, try it out. Don't go trade it live as soon as we get off the webinar here. Go in and demo trade it, for a little bit in your demo account, see how it works, make sure you've got a handle on it, make sure you understand the rules and when to use it, when to not. Once you get it mastered in demo, switch it on over to live, okay? The next strategy you bring on, play with it, master in demo, switch it over to live. It's just kind of your funnel. It's just kind of your step-by-step system. You always start with something in demo, master it, move to live, master it, add on from there, rinse, repeat, okay? So take advantage of that. Some great tools there that Nadex offers you. Apex and Nadex, two complete different separate companies, right? Nadex is an exchange. Apex, we're an online education company, a group of traders helping traders. We've got over 20,000 members. We've got strategies and systems and indicators and live trade rooms. We're a Nadex education partner. We're just here to do these webinars to, like I said, help you be familiar with who and what is Nadex, what are some different ways you can trade them. We love Nadex products. We trade Nadex binaries and spreads every day in our trade room. I've been with Apex now for almost 4 years now as head of operations with them, and I've got a background in banking and as a stockbroker. And again, I'm a trader just like you. All right, we love trading Nadex binaries and spreads. So let's jump right in there. Using Nadex spreads to lower your risk on futures and forex. What do I mean by that? Well, let's say that you're a futures trader or a forex trader, okay? And you're new to Nadex. You haven't really traded a lot of Nadex binaries or a lot of Nadex spreads, and you have your own existing system trading, spot forex or trading the futures markets. Well, what are some ways that you could limit your risk on your futures and forex positions by utilizing Nadex spreads, okay? Now, I'm going to go back in and explain this more in some future webinars, but not only can you use these spreads to hedge off your futures or forex positions, you can also utilize the master daily spread as your main position and utilize other Nadex spreads to hedge that off and to lower your risk, okay? So today we're going to be talking, and the examples I'm going to show you are about futures or forex predominantly, but you can use it with futures, forex, or even use the master daily Nadex spread as your general trend position and use these others to hedge it off. So we're going to talk about how to combine spreads with futures or forex, how to protect your profits, but also let your profits run. And we'll talk a little bit about what instruments you can trade and how many spreads you need to hedge your position. So let's just do a quick kind of jet tour of the basics of Nadex spreads, okay? And I sometimes call them box spreads because if you draw them on a chart, they look like a box, all right? They have a top and a bottom, or what we call a floor and a ceiling. So let's just do a quick example here, real quick. On the Nadex exchange, all products are capped risk. You can't lose more money than you put up to get in the trade, all right? Your risk is the initial cost to enter the trade, all right? And you can trade stock index futures, commodity futures, and cash forex. So like I said, if you draw them on a chart, they kind of look like a box, all right? And what you want to be aware of with this spread, all right, is they have a top and a bottom, or what we call a ceiling or a floor. Now let's just look at an example here. Let's just say this was a euro dollar. Let's say it had a bottom or a floor of 1.2400 and a ceiling of 1.2500. So that means there's 100 pips between the floor and the ceiling of this spread. This is a 100 pip wide spread. Now, I'm just simply using this as an example, all right? Do not get in your head and do not get confused because I just happen to use a 100 pip spread as an example. Don't get confused that it's like a binary. that at expiration is worth either 0 or 100. They work completely different than that. All right, so for this part of the basic spread overview, forget everything you know about binaries. Okay, they do not work the same as binaries. They're not all or nothing. Okay, so the spread is the difference between the floor and the ceiling. This particular one is a 100-point spread, 100 pip spread. It moves in pips or ticks. Okay, pip is the last digit quoted. All right, so 1.2500 or 1.25249998 and so on. Okay. Now each pip is worth $1. All right. So there are 100 pips total in this spread, you know, from top to bottom. Okay. Now let's just use a quick example. Let's say that I was selling a spread. Well, that means that my strategy, my system, my charts, my indicators, whatever bias I have is telling me to go short, to go down. The market is going down. All right. Now, if I'm wrong and the market goes up, if it goes above my ceiling, okay, I don't lose additional money above the ceiling. My risk is capped at that ceiling. All right. I also don't get stopped out. All right. This is very, very important here. All right. This is a very basic elementary thing for those of you that are familiar with spreads, but this is very important to the strategy I'm going to teach you here in a minute. Is just because the market hits a floor or a ceiling, it does not close out the trade. The trade is still open, okay? So look, I don't lose any additional money above the ceiling if I'm wrong and it goes up. But I also don't make additional money below the floor. Does that make sense? So going short, selling a spread, the ceiling caps my risk, the floor caps my profit, okay? Remember, like I said, it's like a box, top and bottom. So as an example, the ceiling right here is at 2,500. If I sell this spread at 24.90 right here, what is the difference? 2,500 is the ceiling, 24.90 is where I sell. What's the difference from where I sell to the top, to the ceiling? 10 pips, right? Okay, each pip is worth $1. So there are 10 pips. So my cost to enter this trade and my max risk on the trade is how much? $10. Okay. So if I sell right here at 24.90, thinking the market's going to go down, but the market goes way up here to 2,600, like 110 points against me, 110 pips against me. Do I lose 110 pips? Am I down 110 pips? No. Because my only risk is to the ceiling. I don't lose any more money past the ceiling, no matter how far up the market goes. Does that make sense to everyone? Okay, the ceiling caps my risk. Okay. Also, again, if the market flies way up here and goes past my ceiling, it does not close out my trade. My trade will only close out if I manually close it early, or if the spread expires. Okay. Joe says, John, very well put with the terms. Yes, exactly, Joe. When selling, the ceiling caps my risk, the floor caps my profit. Again, don't get overwhelmed with spreads or make them more confusing than they are. Draw a box. You got a top and a bottom, a ceiling and a floor. One caps your risk, one caps your profit. You're living within that box, right? Your trade is within that box, up or down, profit or risk. No matter what the market does outside of that box doesn't affect you directionally, okay? So I've got $10 of risk. Now, there's 90 pips of profit potential in this spread, right? So if I sold right here at 24.90, the most I can make is all the way down here to the floor of 2,400. Okay, so the most I can make is 90 pips, each pip being worth $1. So the profit potential is $90. Now look at this example right here. It kept on going down here, didn't it? But on this particular spread, I didn't make any money every tick it moved down here past my floor. I only made money to the floor. Make sense? Also, again, just because it comes down here and hits my floor and it hits the maximum profit amount I can make, that does not automatically close my trade out, right? I have to close it myself or it has to expire. And also look what happens here. Now all of a sudden it comes way back up here and I just gave up all those 90 pips that I made, right? But then the market came back down. So the trade stays open the whole time until you close it. Now, obviously in this particular example, if I had sold here at 24.90 and it gets all the way down here to my max profit, it doesn't automatically close my trade, but I might choose to go ahead and do so, right? Because there's no real reason to leave it open, going and going, because I'm not making any money, right? Let me move on to my next trade. That makes sense? Okay, so let's look at the opposite example. And again, this is very, very basic. What about buying a spread to where I think the market's going up? Okay, well, it's just flipped. I cannot make additional money above the ceiling. The ceiling, right, Joe? The ceiling caps my profit on a long trade. The floor caps my risk. I can't lose additional money below the floor, and I'm not going to get stopped out. Okay. Yes, Joe, spread box could be a great for a risk-reward perspective or playing a morning or news asset break. Absolutely. Tons of different strategies you can use for morning breakouts, news breakouts. You know, we've got iron condors, we've got ultimate hedge, we've got premium collection with spreads, all kind of different strategies there. And we're going to be talking about some of those here over the coming webinars. Okay. So yes, for buying a spread, it's the exact opposite. If I'm buying, I think the market's going up. I can't make additional money above the ceiling. I don't make additional money above the top of the box. If I think the market's going up and I'm wrong and it goes down, I don't lose additional money below the box. So it all depends on where I buy this spread, right? I can buy the spread all over the, you know, depending on where the market's at or where the price of the spread is, I can buy it, you know, all over the place here. Let's look at this particular example. What if I buy it at 24.10? Okay, well, I bought it 24.10. Where's the bottom? Where's the floor? 2400. So what's the difference between where I buy and the floor? 10 pips. Okay, each pip is worth $1. There are 10 pips, so my cost to get in the trade is 10 bucks. The maximum I can lose, my max risk, is 10 bucks. Okay, if I buy it right here at 24.10 thinking it's going up, but it goes down to the floor of 2400, then I'm down $10 at that time, and it keeps on going way down. From there, I don't care what it does, how far down it goes. I don't lose any more, right? And just because it went below my floor, it did not close my trade. And I'm glad it didn't close my trade. Why? Because it came down, and then what did it do? It came back up into the box and kept on going up. Make sense? Do you see why it's powerful that it doesn't close the trade? Do you see why you don't want it to close the trade just because it hits the floor or the ceiling? Okay. Yes, Mayor, this is being recorded. Okay. So if I bought it there, I bought it at 24.10. The ceiling is 2,500. So I can only make money up to the ceiling. I don't make money past the ceiling. So I've got a potential of 90 ticks of profit. Each pip is worth $1, so a potential of $90. Okay, so that makes sense. Just the basics of spread. You can buy or sell a spread. You've got your floor and ceilings that cap your risk or your profit. And spreads, just like binaries, have expirations. Okay, and you've got all type of different expirations available. If we pop right here on the Nadex platform, you can go over here and you can look at, you know, indices spreads. And if we pull up, for example, the Wall Street 30, okay, the Dow, you got spreads that open up from 12 to 2. You got some 1 to 3. You got some 8 a.m.s to 4:15, some dailies. And if you click in here, in each one of these time frames, you've got different floors and different ceilings, all kind of different options. You see that? And if we look at these here, it's completely different floors and ceilings. All right, these floors and ceilings are set at the top of each hour based on where the market is. You've got your dailies that have different floors and ceilings. You've got a ton of different options, okay? And if you want to know a little bit more about how those are figured and calculated, you can go back and check out those spread basic webinars, and we go through and show that to you exactly how those are figured. And you'll know coming up to the top of the hour pretty much where the floors and ceilings will be. So you've got a ton of options. So whatever strategy or system you're utilizing, you can almost always find a spread that has a floor or ceiling close to where you need it to be to match your strategy or system, okay? And then from there, you just have to look at the pricing, okay? So quite a bit of information there. For example, what if I bought this spread right here in the middle at $24.50, okay? So the market was right here, the price was right here at $24.50. To enter that trade, how much money do I have to put up out of my Nadex account to enter that trade if I want to buy this spread at $24.50? Because I'm buying it at $24.50. The maximum risk is what? From $24.50 down to $2,400, right? $50 is my maximum risk. So $50 is the amount that I have to put up out of my account to enter the trade. Does that make sense? Everybody got that? Did I lose anybody right there? The amount that you have to put up out of your account to enter a trade is your max risk. Okay? And what is my max reward? What's the most I can make if I bought right here at $24.50? Well, the most I can make is from $24.50 up to $2,500. Okay? What if I bought at $24.30? How much money would I have to put up out of my account to enter this spread trade if I bought right here at $24.30? $30. Right, Joe? Because Joe, the floor is at $2,400. Okay? If I'm buying at $24.30, there you go, you got it. Then $30 is the most that I can lose. So that's the most I have to put up. That's what I have to put up. Does that make sense? Some people are like, I don't understand why I have to put up so much on certain these spreads and how that's calculated. It's very simple. You're putting up your risk. What if I bought way up here at $24.80? Well, what can I lose? I can lose from $24.80 down to $2,400, $80. So that's $80 is the amount I have to put up to get it in that trade. It's that simple. Make sense? And it's the same going the other way. Okay, so I can close the trade early. I can buy it here and exit when it's right here. I can buy at $24.10, and then when the market gets up to $24.50, I could exit early. And so I bought at $24.10. I can get out at $24.50. What's that difference? 40 pips, right? Each pip is worth how much? $1. So how much would I have made? $40. Now, I could have made money all the way up to the ceiling, all right? But I can get out anytime I want. Does that make sense? I don't have to wait for the floor or ceiling. I don't have to wait till expiration, okay? And remember, it's not all or nothing at expiration like a binary. A one tick difference in a binary can be the difference of 0 or 100, right, Joe? A one tick difference on a spread is how much? $1. Make sense? So yeah, some great risk management, a great way to mirror the market. Okay, so there's a quick overview of the basics of spreads. Okay, so let me talk to you real quick about the whipsaw elimination strategy and the ultimate hedge strategy. Okay, how to combine spreads with your futures or your spot forex as a hedge. Okay, you can also do this with the daily. When I say the daily Nadex spreads, I'm talking about these here, like the 8 a.m. to 4:15 or the dailies. All right, any of these spreads in here, you can use these master spreads. You know, maybe you're trading futures or spot forex, or maybe you're trading one of these master spreads as your, master main directional trade. And then you want to use these other spreads to hedge them off. See these, shorter term spreads? So again, don't get overwhelmed by that in general. First of all, today, try to just get the basics of this strategy concept. Then we'll do some building on it, okay? So let's look at a chart here. Let's say that you trade spot forex, all right? And let's just say this was the pound dollar chart, okay? And you're looking at your chart, looking at your strategy or system, and you want to sell. You think the pound dollar is going down, all right? And you're trading spot forex. And you've kind of got like a, a trend line going here, right? And you're wanting to sell right in here to go short. Well, in any trading that you do, when you say, okay, I'm going to go short here, thinking the market's going to go down. Well, what if the market goes against you and you're wrong and it goes up, right? Well, that was just like a manually drawn there, Candace. This was just like an example, okay? So if you're selling to go short, well, if you're wrong and the market goes against you, you don't want the market to just keep going and going and going and going and going against you. You don't want to keep losing and losing and losing, right? You have some type of stop area in place, right? You have some type of exit in place to, hey, if the market goes past this, against me past this amount, I'm getting out. And just say, for example, you would utilize this trend line to say, okay, I'm going to go short here, but back up here at this high, if the market goes past that high, I'm going to get out. I'm just going to say, hey, I must have been wrong. I'm going to get out. Everybody understands that, right? Very basic, right? You enter a trade, you got to have a place for a stop to get out if you're wrong, okay? So let's just say that was the case. All right, that area right there, that red line was going to be our stop. The green line was going to be our entry. So we would, for example, let's say we sold right here at 1.5685 to go short. Our stop was up here at 57.50. All right, if it went that far against us, we would get out with a loss. And we would end up risking how much? Well, how much will we lose if the market went that far against us? If we were trading spot forex, I'm not talking about spreads right here. If we were trading spot forex, we'd have to put up over $3,100 in margin just to enter this trade for spot forex at $10 a tick. And if it came up here and hit the stop level, we would have lost $650. That's how much we're risking. Right? Everybody got that? So we go, right? We say, okay, my strategy system, charts, indicators telling me to sell. I'm going to sell. And then boom, what happens? Right after you sell, what does the market do? It shoots straight up against you, hits your stop, and knocks you out. Raise of hands. How many of us have ever had that happen? I think the market's going down. So right here, I sold. And as soon as I sold, the market starts going down just a little bit. And then boom, shoots up against me, knocks me out, and I lose money. We've all had that happen, right? And you get all upset because we don't like to lose money. None of us do, right? We hate when that happens. Yes? But what do we hate even more? We hate even more that as soon as it jumps up against us, gets past our stop, knocks us out, we lost money. What does it do? Oh, crap. Now it went my direction, right? Then you're like double upset, double ticked off, right? But you're like, man, I was right. I knew the market was going down. It just made this quick whipsaw up against me, knocked me out, then it went my direction. But instead of me being able to take advantage of this down move that I properly predicted, it popped up here against me, hit my stop. I lost $650. I'm down $650. Then it comes all the way down here. And you're just ticked off. Yes? Say yes. You all know you've been there. You all know what happens, right? Like, it's bad enough when you get stopped out and you lose money and the market goes the other way than you thought. You're like, oh man, I called that wrong. Oh, but you're more upset. Like I said, you're double ticked off when it goes against you, stops you out, you lose $650, then it goes right where you thought it would go. Like, that's just even more frustrating, right? That's what we call the whipsaw effect, where the market is going down, but it whips back up here and takes out everybody's stops, then it goes down. And in this particular situation, you had to put up $3,100 out of your account in margin just to trade this. And you had to risk $650 for this full lot of Forex. Okay, that's Forex trading. Now, what if we were trading a spread in this very same exact chart and very same exact scenario? Remember? So we were right here. Okay, remember? We were right here wanting to what? Sell, because we thought the market was going down. Now, on a spread, each pip is worth what? How many dollars? Each pip, $1. Now, in the example I showed you a second ago, trading spot Forex, that was $10 a tick, right? Because a full lot is $10 a tick. So I'm trying to be fair here. You should notice I have 10 spreads here. Okay, because I want to show you the same $10 per tick. So to equal out, I'd have to have 10 spreads to make $10 a tick, correct? So I want to give you accurate examples. So same situation, I think the market's going down. I want to sell. I sell 10 spreads at 56.65. Okay, so I sold at 56.65. Where is the ceiling of this spread? 5,700. If I'm selling to go short and the market jumps way up here, do I lose money past the top of this spread? Do I lose money past the ceiling of this spread? No. So if I sold at 65, the ceiling is 57, that's 35 ticks of risk, correct? That's my max risk, is 35 pips, $35 times 10 spreads. So $350 is the total amount that I will risk here. $350 is also the total amount I have to put up to enter the trade, right? Because I only have to put up my risk amount. Make sense? I enter the trade to go short. What happens? Same thing, same chart. Boom, the market jumps up against me way up here. How much am I down right now? How much was I down right here? $35 per spread times 10 spreads, right? 350 bucks. And every tick that it goes against me, am I losing more and more and more and more and more and more and more? No. I can't lose past here. So my only risk was from right here where I sold at 65. My risk was up here to the ceiling. It can keep going all at once and I don't lose anymore. Also, when it hit my ceiling, oh man, well that trade's over. That trade's closed out. Is it? Did the trade get closed out? No, the trade is still open. And I'm glad. Why? Because what do we know is about to happen? Boom. It came back down, came all the way down here, and the spread expired. And it expired down here at $55.89, and I profited $760 on this trade. So you see that, guys? Same chart. Same chart. One example, just trading straight Forex, spot Forex. Another example, trading Nadex spreads. What was the difference? On the underlying, on spot Forex, how much did I risk? I risked 650 bucks. Remember? On Nadex spreads, getting the same, $10 per tick because we got 10 spreads. My risk was only 350 bucks. How much money did I have to put up in margin to get into that spot Forex trade? I had to put up over $3,100 to get into that trade for Forex. On the Nadex spread, I only had to put up $350. Okay. And what was my result on those two examples? I had my stop loss set for my spot forex, and I would have lost $650, right? But what was my result on the Nadex spread? Well, I had a capped risk. I didn't need a stop on that one. I had a capped known risk ahead of time. It popped up against me, then it came down in the direction I thought it was going, and I resulted in $760 of profit, as opposed to losing $650. I had $650 risk as opposed with Nadex $350. I had $3,100 margin as opposed to $3. Did you get this, guys? Did I lose anybody right here in those two comparisons and this side-by-side comparison? Do you guys see how that worked and why it worked that way? Do you see the power of that? Okay. It's very similar, Nair, except you've got capped limited risk up front and a little less margin, okay? So does everybody understand those two examples right there? Do you see the comparison? Now, I'm not here trying to give you a sales pitch for you to stop trading Forex and come trade Nadex spread. This isn't a sales pitch. I'm actually going to show you here how you can keep doing it. You may have a great strategy or system, although, okay, I say it's not a sales pitch. You keep doing it, but just look at the chart in front of you. Like, look at your options there. Look at your capped risk. Also, what happens when one of these flash crashes hit, like happened on dollar franc a couple years ago, or boom, out of nowhere, there's a 300-point move in pound yen, and it goes way against you and you lose a ton of money in the Forex market. Well, that didn't happen on Nadex because you have a capped risk. It's not unlimited. Your risk is capped even in a flash crash. Make sense? So if you're a Forex, spot Forex trader, you need to take a look at some Nadex spreads, okay? But let's say that you are a Forex trader and or futures trader, works the same, but we're gonna talk on, the examples are gonna be Forex. You have a great strategy, great system, you love trading your Forex, okay? But you want to hedge them off. Let's take a look at something here. Again, let's look at the same exact chart, okay? We already went through this example here, okay? Now, let's look at this chart here. Same chart, and I'm trading spot Forex, okay? I'm gonna sell because I want it to go down. But when I'm trading spot Forex, I happen to find a spread that has a floor up here at 5,700. This is the bottom of the spread. The top of the spread is up here, right? Everybody remember, the spread is the bottom of the box. The ceiling is way up here, okay? Follow me close here. And this spread happens to be a 250 pip wide spread, okay? So the floor is down here at 5,700. 250 pips up here is the ceiling at 5,950, okay? Now, remember, I'm down here wanting to sell my spot Forex to go down, right? Okay? So, with spot Forex, it's $10 a tick on spot Forex for this full lot, right? So to equal out, I have to use 10 Nadex spreads because a spread is $1 a tick. So if I want to equalize $10 a tick, I got to use 10 spreads. So let's say, okay, that the spread floor is 5,700, but I can buy spreads at 5,710. So here's the floor. I can buy up here at 5,710, right? What is my risk on each spread? If I buy at 5,710, the floor is at 5,700, there's 10 pips of risk there, right? So $10, and I'm going to buy 10 of them. Okay? So my risk is $100. And how much do I have to put up to enter this trade? $100. Everybody follow me? Floor is 5,700. I'm buying at 5,710, and I'm buying 10 of them. Now, everybody's like, well, wait, why are we buying here? Because I thought every example on this chart, John, we were selling. We are. Watch. So, in this example here, when we sold our spot forex right here, remember the very first example? We sold right here, but it shot way up against us. Remember, we had our stop at this level, and it knocked us out. And how much did we lose on the spot forex in that first example? Do you remember? We sold here to go short. It jumped up here and knocked us out, and we lost $650 on our spot forex, right? Okay. So right here when we sell, and it starts to come up against us, when this market gets up here to 57.10, what do we have at 57.10? What did we buy at 57.10? We bought 10 Nadex spreads, right? So if I sold my forex right here, okay, Gary, stop calling. If I sold spot forex here, every tick it goes against me, I'm losing how much? $10, $10, $10, $10, $10. But what happens right here at 57.10? When the market hits 57.10, I'm still losing $10 a tick on the spot forex, but I'm making $10 a tick on the spread. So it equalizes out. Does that make sense? It hedges off that position. Does that make sense, guys? And remember before when I wanted to exit up here and take a $650 loss? Okay, Candace says, no, it doesn't make sense. Okay, so Candace, do you remember on this chart example when we sold the spot forex right here because we thought we were going down? But as soon as we sold, the market popped way up here past this previous high. So we got out, right? And we lost $650. You remember that? Okay. So this is the same example. Okay, we're doing that same exact thing, Candace. We're selling spot forex because we think it's going down. But instead of when the market gets up here, we get out with a $650 loss. Look at this Nadex spread. We bought these spreads. See, this has a ceiling of 5,700. We bought the spreads right here at 57.10. So as the market's going up here, we're making $10 a tick on this spread. At the same time, we're still losing $10 a tick on this spot forex, but we're even out. Does that make sense, Candace? We're losing on one, but making on the other, so we're zeroed out. Now also, Candace, remember this spread at the top here? Remember how big I said this spread was? 250 ticks. Remember? Because the bottom was at 5,700 and the top was at 5,950. So the market could keep going 250 pips against me. Like I could be wrong and the market go 250 pips up there against me. And for those whole 250 pips, Candace, I'm losing 10 on one, making 10 on the other. So where am I at? Zero. No loss. Even. A hedge. Break even. Makes sense? Everybody got it now? I'm glad you asked, Candace, because if you're asking, said, hey, I didn't quite get that, that means 10 other people probably didn't either. Okay, and that's good. Does that make sense now? So what is the realistic here? where do I start being even and being where one cancels out the other? Well, where did I buy? At 57.10. Okay, so my only true loss, or my only real risk on this trade, is from where I sold the forex to the 57.10. Does that make sense? Because it could keep going way, way, way against me, and I'm evened out all the way up to 250 pips. Now, if it kept going and got to 250 pips, then I want to close both trades out, right? Because I'm not protected past that. Make sense? But right up front, when I enter these trades, I know exactly where my risk is. Because remember, on the spot forex, I sold it at 56.85. Okay. Remember, I had that stop. Where's my stop now? Remember, my stop was right here. Okay. Remember, my stop was right here on the initial forex trade. Now my stop is another 225 pips above it because I'm covered all the way up there. Does that make sense? Lau, I actually would have a stop, but the stop would be at the top of this spread, because after the top of this spread, I'm not covered anymore. Does that make sense? But instead of my stop having to be right here, Lau, it's another 200 something pips above. So as soon as I enter this trade, is my heartbeat racing? Am I freaking out? Am I stressing? What do I know? I know that my risk is from right here where I bought to right here where I got the spreads. Here to here is the only amount that I can possibly lose past up here at the top of the spread. And where is that? From where I sold the spot forex to where I bought the spreads, it's $250. My risk is $250 on this trade. As to where before, where was it? My risk was $650, and if it went up there and hit that 650 loss level, my trade was closed out. So remember that example? I lost 650, then it came my direction. But here, I lock it in. I know my risk. I know exactly where I'm at, and I know my potential. And what happened in this situation now? Well, it pulled up here and came back against me. Oh man, I don't like that. But it didn't knock me out and close my trade and make me lose 650. And then after I lost 650, come back in my direction and make me mad. Remember what I called this earlier, the ultimate hedge, but I also called it the what? The whipsaw elimination strategy. This is a whipsaw where it whips against you, knocks you out, then goes your direction. You eliminate that issue because you have these spreads there. And when it gets up into these spreads, whips on against you, you're not that worried about it because you're not losing anything. And then what happens? It comes back down and it does go in your direction and you're in profit. And your spot forex trade would have profited $960. But now you did take a loss on these spreads, right? Because you had these $10 of risk on each spread times 10. So you made $960 on your spot forex. Take out the cost of the spread, the 10 spreads, which was your hedge. Now you netted $860 in profit. So if you're a spot forex trader, that first example we showed, you lost $650 and then the market went your direction. Here, as a spot forex trader, you trade that spot forex, you put the Nadex spreads on as a hedge, your heartbeat's not going crazy, you've got a huge crazy stop, right? Less stress, and you ended up with $860 profit, as opposed to a $650 loss. And instead of a small stop, you had a almost a 250 tick stop. You can't beat that. Okay, so does that make sense? Does everybody understand the general concept of this ultimate hedge strategy and how to utilize these Nadex spreads with your futures or forex trades to help hedge them off, okay? And to give yourself much larger stops, okay? Now, guys, again, we could go on and on and on here, and I'm running out of time. This was just kind of the basic webinar to give you the basic idea of how they work and to let you start looking for them and testing them and demo, okay? If you're a forex or futures trader, hop on over to nadex.com, get the demo account, and every time you take a futures or forex trade, find yourself a hedge, okay? Find yourself a hedge, throw it on the Nadex demo account, and get to know these things. And then we're going to do more and more webinars here upcoming to show you some more examples, okay? And some other ideas and different ways to trade them. So just keep in mind, you know, your hedge is to the floor if you're going long or to the ceiling if you're going short, okay? You got to remember, you're hedged off dollar for dollar, $10 for $10, up to the top or bottom of that spread, depending on which way you are going, okay? Also, like I said, if you're not a futures or forex trader, you can use the large master spreads as a replacement for that. Like, let's say that on that example, instead of trading spot forex, you were just trading a master Nadex spread, you know, that's a much bigger spread, and you're hedging it off with the shorter 2-hour spreads, for example, okay? So you're usually using the intraday spreads. They're cheaper. They're great for news trades. We'll go on and more. You know, just as a quick example, whatever strategy your system you're trading, right? Let's say you've got a chart here with a, you know, and your setup is right here on these green bars and you're going long, okay? And you're buying, you know, this is the NQ, all right? This is the NASDAQ. And your strategy system telling you that you're going to go long with a futures contract, okay? And you're entering right here to go long on a futures contract. Well, what are you looking for? Well, you're looking for a Nadex spread that has a ceiling. If you're buying futures or forex, you want a Nadex spread that has a ceiling as close as possible to that same entry. So that if you're wrong, then you've got that spread hedging you to that downside. Make sense? Okay, or the opposite. Let's say whatever strategy or system you're trading, you're going short. You're going short a futures or forex contract. You think the market's going down. Well, what you want is a spread with a floor as close as possible to that same entry to cover you if the market goes against you the other way. That's just kind of another visual example there of what you're looking for, okay? So, you know, some other tips here. You know, the less time to expiration, the less premium, so the less risk on the hedge. You know, you don't need the spread also after you trail your stop. You know, if you're trading spot forex and it's going in your direction, you're trailing and trailing and trailing, you can get out of the spread. But all kind of other tips and longer term stuff here that we'll cover on some upcoming webinars. All right, I don't want to overload you here, but now you can see this, kind of implement it, start playing with it in demo. I think you can see the value in this strategy where it eliminates those whipsaws and kind of hides your stops, and you've got stop losses for pennies on the dollar, right? We just showed you how to take a $650 potential loss down to only a risk of like $2 or $250. And then instead of giving yourself, you know, a small stop, you have a 250 tick stop. Like, you can't beat it. So, Joe, we will go over that on some future webinars. Okay, I'm actually out of time here today. I've kind of gone over already. But guys, I appreciate you being with us. I hope that this webinar helped open your eyes to the power of Nadex spreads and opened your eyes to some ways that you can utilize them as a futures or forex trader in order to hedge off your positions and make sure to join us on some upcoming webinars. We're going to dig a little deeper into some of this over time and show you a few more awesome strategies for directional, hedging, premium collection, all kind of great stuff using Nadex spreads. So, okay, guys, thank you again. I hope you have a great rest of your trading day and a great weekend here. And we will see you on some of the next upcoming webinars. Thank you so much, guys. Have a great one.